Thank you, Aditya, once again for having me, and good afternoon, everyone. My name is Saurabh Jhalaria, and I'm going to talk about the topic which is mentioned on the slide: innovation in Indian fixed income investment. And I think the most relevant thing is what we see the innovation coming in the last few years, and which we think will multiply over the next 5 to 10 years, is emergence of closed-ended investment vehicle, which is in the form of Cat2 AIFs, of providing a very, very attractive investment alternative for investors. And I'll sort of go through this presentation to take you through my thoughts on the sector. So just a table of contents, but I think the first and most relevant thing is we all know India is a very underpenetrated debt market. The private debt to GDP in India is a fraction of what it is in some of the other developed markets. Couple of reasons. On the demand side, I think a lot of the debt which is borrowed by the government entities, because a lot of PSUs that conduct business in India is not part of this private debt. And second, on the supply side, again, most of the debt in India is done through balance sheets of banks that are buy and hold. And that sort of, again, reduces the amount of debt that's available compared to capital market intensive countries like UK and US, where the lenders own less than 25% of the total debt, compared to India, where it's about 90-95%. Just in terms of, I think, the overall within this, when we look at who are the players in India, it's very clear that almost 75% of debt that's provided to Indian corporates or household is consisting of banks, NBFCs, and HSCs. Whereas the mutual funds as well as the bond market is less than 25% of the total amount of credit. So this just tells you how underpenetrated India is from the supply side on mutual funds and bonds. I think this is probably where the crux of the problem is. If you look at, it's a busy slide, but I'll sort of talk you through why our analysis is it's a good time to be a private debt investor in India. Is the banks, the large banks, the table on the right-hand side, whether it's ICICI Bank, Axis Bank, Bank of Baroda, SBI, are reporting an increase in credit that they are disseminating to borrowers that are rated A- and above, right? What does it mean is there's a flight to quality. 2018 onwards, Indian economy has had its own share of issues, first with the demon, then with GST, and then finally with COVID, and in between, if you throw in the ILFS and DHFL crisis. There's been a big change in the mindset of Indian banks. Second, if you look at on the table in the middle, banks are increasingly lending to entities which are A- and above, or to retail, right? So it's been a big barbell strategy where banks are trying to get into retail lending, but on the corporate side, sticking to the more established borrowers, right? Which is very evident from when we look at the overall credit breakup and from their own balance sheets. The second category of investors in this segment were the mutual funds. And if you just look at on the table on the left-hand side, within 2019 September, right after ILFS strategy, when this was still a very prominent investment, credit funds used to be about 6% of total AUMs within the debt schemes. It's now shrunk to almost 2%, right? The largest player, Templeton, had its own share of issues, and they vacated the market and had to put up gates, and investors had some heartbreaks. But I think the most important thing is people didn't lose money. Our view is that the asset liability mismatch, or the fact that they were investing in illiquid credit investments with an open-ended mutual fund strategy, that was probably what the market is pushing back on, and hence emergence of closed-ended AIs to sort of match where the funds are lending versus the fund life itself, which is a closed-ended fund. And then what it means is between 2017 and 22, just in 5 years, there's been a big change in the macro supply of credit, right? The AAA to the A+ segment, which is the 12% rating zone, I think there we haven't seen much difference. The banks, mutual funds, and NBFCs play. The extreme right-hand side, the special sits and distress, once again, not much difference. It's the foreign investors, the foreign debt investors, maybe foreign banks, and the Indian ARCs plays. The segment in between the middle, the 13 to 18%, what is called performing credit space, is where there has been the maximum change in the composition of who are players in the market. This is the A minus to the single B rated segment, 13 to 18%. Small private banks, the likes of Yes Bank, the likes of RBL, the likes of IndusInd have kind of retreated to some extent within this segment. Mutual funds are virtually non-existent. Even the NBFCs that used to supply capital, the wholesale NBFCs in the country, have all pivoted towards retail lending rather than focus on wholesale lending, right? And the emergence of these close-ended AIS in the last 4 or 5 years is still a fraction of capital that they bring up compared to what has been vacated by the smaller private banks, the mutual funds, and the NBFCs. So it's really an attractive time and opportunity for AIS to play in this space, but it's been vacated in the performing credit A minus to the B, 13% to 18% kind of a range. CapEx in India is finally picking up. If you look at the GST collections, it's been increasing, inching month on month. The corporate balance sheet has largely been deleveraged. Equity markets have held, a lot of equity has been raised. But I think we're starting to see offshoots of CapEx demand, whether it's coming up in sectors that are finally seeing capacity increases, or the capacity utilizations are picking up as some of the government schemes like PLI schemes gain momentum for the Make in India movement. And then I think the final point here on the macro is the demand for credit from emerging corporates, the new age entities, is also picking up. I mean, it's a meaningful setup now in India where almost 100 companies have sort of become unicorn. And these are now employing huge amount of people, disrupting a lot of different industries. And equity is flowing in, barring the funding winter that we've seen the last 6 months. But over the last 2-3 years, there's been a lot of equity that this sector has raised. And on the regulatory side, once again, given the IBCNA and a lot of the precedents around solving of bad assets, now I think as a lender, pre-17, I think you had to rely on the borrower or the promoter to pay up. Otherwise, the regulatory framework wasn't conducive. But I think the discipline that now with the financial governance and the threat of going into bankruptcy is forcing borrowers to lever up wisely rather than lever up maximum, and also adhere to financial governance or payment restrictions much more versus what it was. I think just take you through the overall, how do the debt AIS stack up as a comparison, as an alternative to other fixed income investments that's available. I mean, from sovereign bonds or the GSECs, anywhere between 7 to 8%, depending on what tenors. And I'm talking about not the tenure, but more shorter end to kind of compare with where the AIFs are. Bank FDs anywhere between 4.5 to 6.5%. One emergence that we've seen is in single name corporate NCDs and MLDs. A lot of investors have kind of expressed interest into going into single name NCDs or MLDs, given the tax efficiency. They are in the range of anywhere between 7 to 9.5%. And then the corporate funds or the credit risk funds, which focus largely on the AAA or the AA segment, maybe about a 1% lower or 100 basis points lower return because of the diversification benefit, but there's a fee that these guys charge. And when we compare it to where the debt AIS in the country are committing to sort of generate returns, it's in the 13 to 18%. So we think it's almost a no-brainer for investors to look at this, given the diversification, given the active portfolio management, and given the tenor of these are largely matching some of the other investments that are available for mutual fund for investors. Just a comparison once again in terms of where these closed-ended debt AIFs are better or worse, or how do they compare to the two sort of comparables. One is the open-ended mutual funds, and the second is the traded single name NCDs or MLDs. It's a diversified name similar to the mutual funds compared to a traded bond or an MLD, which offers a more idiosyncratic or a specific concentrated risk on a single name. most of the funds carry some sort of both credit risk as well as interest rate risk, whereas closed-ended debt AIFs, given their matching inflows and outflows, only carry credit risk. So as long as we are holding a bond to maturity and repaying the investors at the end of the tenor that we've committed, the closed-ended AIFs only carry credit risk. The taxation is different. The taxation is marginal tax for credit or debt-ended closed-ended AIFs compared to capital gains for open-ended mutual funds. And traded bonds and MLDs have marginal tax or capital gains depending on what's the tenor of holding and whether it's an MLD or an NCD. Liquidity, obviously, for debt AIFs is low, given some of these are close-ended and you have to hold it to maturity. That's one thing where debt AIFs lose out compared to the open-ended mutual funds and traded bonds and MLDs. And finally, the product orientation, open-ended mutual funds, a lot of investors are retail in nature. Traded bonds and MLDs largely are HNIs and family offices. But besides HNI and family offices, a lot of institutions like insurance companies and pension funds are committing more and more to the close-ended debt AIFs, given their ability to cherry pick the right strategy and the right manager. It's also a sector that is getting a fair bit of liquidity and also the returns that the funds have generated. These are all from CRISIL reports, so all audited numbers. If you look at since FY17, these funds have generated anywhere between 10 to 15% return on a net basis. Some years have been better, or some years have been worse. But now we have enough a track of a lot of capital that's gone in, and the investors can see the range where these returns have been, and generally they've all very well outperformed the vanilla debt mutual funds. And the capital that this segment is attracting is increasing. It's now 2.23 lakh crore across all category 2 funds compared to 84,000 about 3 years back. So there's almost market has tripled in the last 3 years, and we expect this growth trajectory to continue. Now, in terms of what does this mean for what are debt AIFs doing to capitalize on this opportunity, which is on one side totally constrained with the participants like banks, NBFCs, and mutual funds exiting, and on the other hand, a demand for credit coming back both from emerging ecosystem as well as established corporates as capex cycle picks up, is basically saying this is a alternative to a traditional debt, where you offer a high return, but you offer a lot more flexibility compared to traditional debt. And when this is compared to traditional equity, like a private equity, this offers a lower return, or investors get a lower return, but a lot more stability as far as repayment or the tenor of their instrument is concerned, right? So this slide just talks about, I think, the growth needs or capital structure or event, which are, classic cases for why private debt is needed. I want to put your attention to the table below, which is private equity, a lot of upside sharing. Traditional debt is generally a fixed return, low return instrument. Private credit tends to be more expensive than traditional debt, but less returns that investors will expect to generate compared to private equity. But the key difference versus private equity here, 100% of the principal is protected. Most of these private credit instruments are well structured with security, with scheduled repayments, compared to private equity, where you're taking the risk on when the company gets listed or are unable to sell my stake in the market. Similarly, monitoring rights are less compared to private equity, but significantly more compared to a traditional debt. Most of the private debt come with very, very onerous covenants to ensure that the debt stack is protected. Very frequent MIS reporting and covenants on that, as well as management interventions and discussions with management frequently. Return profile is medium to high, so it's somewhere sitting in between a private equity and a traditional debt. And the diligence requirement for private credit is very similar to what investors will do on the private equity side. And the timeline to commit is also something which is comparable more to private equity than to the traditional debt. When we look at the country in terms of what these private debt or the CAT2 debt instruments are offering, I think we can break it up into 5 different subcategories, right? There's the traditional credit to other financial institutions, lending to other NBFCs and MFIs. These yield anywhere between 11 to 14%. These are also shorter tenor products between 2 to 4 years of maturity on the underlying investment, and debt AIFs and similarly will have a matching or maybe slightly longer. Emerging corporate credit, which again consists of either venture debt or just vanilla debt. Some of these come with warrants attached to it, so investors can participate in the upside of some of these companies. They yield anywhere between 13 to 18% return. The established corporate credit, which then deals with more traditional manufacturing businesses, and some of the sectors that are good consumers of emerging corporate credit are auto ancillary, chemical, pharmaceutical, sort of a lot of where there are mid-sized companies in that space which consume corporate credit through the private market. Real estate is another asset class which is very, very different to all of these. Yields are much higher, but given some of the challenges in the economy in the last 3-4 years, we've not seen a lot of new fundraisers that have come up in the space. And finally, the entire special sits and distressed credit, which focus on almost equity kind of returns, because these are event-driven risks, concentrated risks, which more institutional investors understand, given the return profiles are a lot riskier, but much, much higher. So the entire debt AIFs are innovating across one of these five strategies, and whether it's a low risk, low return 11% number or a very high risk, high return 18+% number, all of these categories appeal to different investors depending on what the risk and the return requirements for each investors are. And finally, in terms of what are in terms of closing remarks, I think the market is set to explode on account of innovation, benefits that this provides to investors compared to traditional debt, and where I think we've seen a lot of debt AIs come up is in slightly moderate risk, but also beating the mutual fund returns. We think the space will expand because a lot of investors are coming up with different requirements for what whether it's asset liabilities provide, where their diversification needs are, what tenor are they willing to commit capital for, what segment are they interested in backing. So this segment itself will increase in terms of more better sort of coverage of the risk return curves. In terms of what does the industry need from whether it's regulators or investors for its next leg of growth, I think number one point is taxation parity. So while mutual fund investors, one of the disadvantages of debt AIFs is that as a mutual fund, you get benefits of a lower taxation compared to an AIF, which is a pass-through taxation on the category 2. And second is some sort of a liquidity, whether it's on account of listing of fund units or a secondary market, where while you commit for 4 years or 5 years or 6 years, depending on how long or what's the tenor of the fund, but in case investors need certain liquidity at their disposal for some of these closed-ended debt funds, there's a market that allows them to get liquidity. It could be at a discount, it could be what the buyer is willing to pay, but at least you have a choice which right now doesn't exist. So I think these are the two asks, if I may, for what the category 2 debt AIFs have from regulators to kind of make it more attractive, given a big need that it's serving in the economy of disseminating credit in segments where banks, NBFCs, and mutual funds are currently absent. So I think this is this kind of Aditya concludes my session or what I wanted to cover. If there are quick 1 or 2 questions which you have, I'm willing to take it. Otherwise, maybe we just wind up the session and let the next speaker come on.